Welcome to Ben's Market Insights. This week we've got quite a lot to go through. There's a bunch of different news flows that are really competing with each other. On the macro side, we're talking about whether the US is really sort of in a Goldilocks environment. On the micro side, we're going to talk about what RPOs mean for software companies, why software companies are effectively falling apart at the moment, and why this broadening in the market is allowing for a major rotation to occur out of technology and into the wider industrial and a commodity-based marketplace. If you're really enjoying this content, please subscribe to our YouTube channel. Also, give us a thumbs up if you're enjoying what you're seeing. Thank you very much. So let's jump in straight away into what we think is happening with the US economy. In the last week and a half, couple of weeks, we've seen ISM manufacturing. This is one of those signs of whether an economy is in expansion or a segment is in expansion or contraction. It's clear that manufacturing is surprising folks and is in expansion mode and hasn't been for quite some time. Inflation is remaining remarkably subdued at the moment. We'd have thought that the tariff implications and other factors have come in to push it higher, but in terms of the cost of housing, interest costs of mortgages and rents, even gasoline costs have been coming down despite food costs going up, but that implies that inflation has been subdued. Employment remaining pretty stable despite the threat that AI is increasingly putting forward. And the University of Michigan has a number of different surveys on their consumer confidence survey. Again, consumers are in expansion mode. The Dow Jones, which reflects the old economy, is in expansion mode as well and has been rising and in fact outperforming pretty much every index at this juncture. So from a macro perspective, we've said this before, we are now heading towards a lower interest rate environment going into the signing in of the new Fed chairman, Kevin Warsh, in May. And that is just going to be an environment that's creating more liquidity and more risk asset upside coming through. But within that risk asset environment, there are clearly some major changes going on. So let's touch upon a couple of interesting points. RPOs, which stand for remaining performance obligations. These are effectively the total value of contracted products or services that are yet to be delivered. And this is very much a software term. So for instance, Microsoft has an outstanding exposure to OpenAI of some 45%, which is of the $650 billion worth of orders that OpenAI has outstanding currently. So in other words, Microsoft's Azure data center platform has to go out and build out this platform based on OpenAI's contract, but has no assurance that OpenAI can fulfill those contracts. And that is a major risk that clearly software is having, on top of what we'll come back to later, what the market is beginning to call SaaSmageddon, which is an interesting reference. So these RPOs are becoming more and more significant, and almost invariably the exposure is almost always ends up with OpenAI. OpenAI is a private company in the process currently of raising $100 billion. And if you like, almost the entire AI story over the next 3 to 4 years is largely reliant on OpenAI coming through with its promise of extra compute, extra opportunity in terms of using its ChatGPT platform, but also that all of these data centers are able to fund their expansion. With that in mind, we're clearly seeing a major expansion in the capex spend that all of the data center providers are building out at this juncture. And that really, Amazon's announcement a couple of weeks ago really spooked the market here. So they doubled their capex for this year to just under $200 billion. That is accelerating at such a pace that it's hard to see how you make a return on this amount of outlay over a reasonable period of time. And just to kind of, again, sort of put that into context, I think that there is a capacity to be able to raise the compute and returns given that at this juncture, for instance, in the case of Amazon, only 15% of their data center capacity is currently configured for GPU AI facilitation. So there's still a long way to go. And if we want to have this level of compute that, for instance, will replace software companies, that's not going to happen without a huge increase in capacity, which presumably is very margin enhancing at the AWS and revenue growth at the AWS level and the other data center providers. I think that the fact that we are seeing data center growth, according to some estimates in the market, at somewhere between 2 trillion and 2.5 trillion between 2024 and 2030, with a total spend that Gartner is forecasting for IT of 7 trillion over that same period, then it's clear that there is an incredible amount of capex continuing to increase momentum, and we're going to hear more of capex going up, not down. And that may still continue to spook the market and create this, if you like, sort of market disruption that we're currently seeing at the moment. Interestingly enough, there was a comment by Jensen Huang, the CEO of NVIDIA, who's again at the heart of supplying the hardware, who's saying that, in fact, that they're running out currently of their 5-year vintage GPUs that they developed some time ago. So it's not even an edge issue. It's just across the board. GPU demand is very, very strong. He interestingly also suggested that Meta was one of the kind of key winners, as we've always been suggesting, where their AI, if you like, targeting is allowing them to increase margin. And we certainly saw that in their results, with margin per, or the cost per ad coming down and the margin improving as a result of being able to really pinpoint much better than before the kind of customer that the brand is, if you like, looking to go after. And again, YouTube is also under, from Google's perspective, doing a similar level of success. So let's turn to software at this juncture. Clearly, software companies, led by Microsoft's announcements, mostly around their data center spend, not really on their software platform, but the software sector has been absolutely crushed in a very similar way that it was crushed in the late 2000s when we started moving from a perpetual platform towards a licensed platform, and the SaaS model became the acceptable way to do business on an annualized, if you like, rolling license basis. And that resulted in a perspective that some companies were just not going to be able to have, or didn't have the depth of relationships with their clients to be able to continue their relationships on an annualized rolling basis. But clearly, winners came through. SaaS companies who specialized only in that form of delivery did incredibly well. And in fact, the likes of the time ServiceNow and etc. started to grow significantly, including all the big names that we know today. We're back to that again now. And we're now under the assumption that AI is going to destroy the software model. And again, not all software is born equal. There are certainly software vendors that are generic in nature, supply workflow type of product that will get hampered, that will get potentially sidestepped by AI functionality. But I think that those sort of software companies like a Microsoft and others, and we talked about Experian a couple of weeks ago, these are businesses that do have two fundamental elements to them. So a software business eventually becomes the brand and the distributor of very deep tech ability in a vertical. In Microsoft's case, that's the likes of, we're not going to replace Excel by AI. AI will sit on top of Excel and make Excel better, but Excel is going to stay where it is. In the case of Experian, it's slightly different, where we have a walled garden of data. It's very unlikely that AI can come in and replace that. So I think that we really need to think very hard about those sort of software businesses that can survive this Armageddon or SaaSmageddon scenario, which have their own data that keeps AI and LLM, if you will, or large learning models, out of their data set, and so that they can continue to provide proprietary services, And so it is those businesses that I think will continue to grow. It is vendors that are generic in nature and workflow in nature that I think will fall away unless they're able to strengthen their relationship with the customers. But let's not forget, IT company or IT provision, that whole $7 trillion worth of market is sitting with big financial companies, pharmaceuticals, etc., who are very, very loath to replace strong relationships with new ideas and new opportunities, even if they do come cheaper. This is a long process. So I think it's very important to look at this dislocation and potentially take advantage of that. The final thing I'll talk about very quickly is around this market broadening. Clearly, the S&P equal weighted has now in the last few weeks been doing incredibly well. In fact, has outperformed year to date the S&P cap weighted index, in other words, that index which is dominated by the Mag 7 by some 4.5%. But over the last 5 years, the cap weighted, i.e. Mag 7 platform has outperformed the equal weighted S&P by 27%. So there's potentially a long way to go yet. However, having said that, it's all about earnings growth and momentum in terms of the ability of companies to grow. And if we look at the S&P 500 earnings forecast, it's running at 14% this year compared to, running at 21.5 times PE. But if we start thinking around some of these companies that have become disrupted, Amazon is on 23 times, but with some 30% earnings growth. Meta is on 20 times with 32% earnings growth. Google's on 27 times, but 30% earnings growth. So when we look at some of these companies in the Mag 7, they continue to have the earnings momentum. And I suspect that whilst this rotation still has some way to go, the turn is going to come soon. And over the next 3 to 4 months, we'll probably start to see an equalization back towards Mag 7. But in the meantime, the S&P, both equal weighted and cap weighted, will perform relatively well. I'll stop there. Thank you very much for your time. Speak to you soon.